Good evening, ladies and gentlemen. Thank you for joining us at Corporate Connect. This webinar is organized by SIAS and supported by SGX. Today, we have with us Mr. Geoff Howie, the market strategist from SGX, to share with us on market updates, followed by a presentation by Sri Trang Gloves, and we'll end off the Q&A session. Without further ado, let us welcome our first speaker, Mr. Geoff Howie from SGX. Over to you, Geoff.
Thank you very much. Just sharing my screen now, and I believe everybody can see it. Please let me know if you cannot. I'm Geoff Howie. I'm the SGX market strategist and intend to provide an update over the next 15 to 20 minutes, overviewing the current market drivers of Singapore stocks with some added perspectives from the stocks management that are listed on the actual Singapore exchange. We must point out this presentation is designed to be purely informative with recent observations on the moves in the stock market. It is not in any way providing investment advice. Here we are. The 30 constituents of our STI, they represent around 58% of the $900 billion of combined full market cap of all stocks listed on the Singapore exchange as of 30th of June. And the STI generated a 10.1% price gain in the first 6 months of 2021. Dividends boosted that return to 11.9%, and this made it the STI's strongest start to a year since the 13.8% total return in the first half of 2017. The STI was also amongst the strongest 3 APAC benchmarks in the first half of this year, with the FTSE ASEAN All Share Index represented by the light green dotted line in the chart, which generated a 5% total return in Singapore dollar terms. Singapore's broader FTSE All Share Index generated a 12% total return in the first half of 21 as well. This FTSE ST All Share Index, it's comprised of 107, that's 107 constituents, with Sri Trang Gloves Thailand PCL joining the index effective the 21st of June. As an index, this FTSE ST All Share Index, it's currently priced at an 11% premium to book value, and that's after it ended 2020 at a marginal 2% discount to book value. At this 11% premium, it means the current index valuation is moderately higher than the 7% premium to book value observed pre-COVID. When we're talking pre-COVID, as most people would do, we're meaning the end of 2019. But meanwhile, the FTSE ASEAN All Share Index, the green line, has extended its pre-COVID premium to book value by something by 20%, while at the same time generating a similar return to the FTSE ST All Share Index. Now, vaccine progress has provided support for investing in global equities in the first half of this year. However, the COVID-19 infections, they do continue to grow. While we had 3 billion COVID-19 vaccine doses administered globally in the first half of this year, the total number of cases also grew from 84 million to above 180 million, with this contagious Delta variant seeing close to 10 million more cases in the second quarter of this year than we saw in the first quarter of this year. Now, the overarching endemic theme has seen the STI really consolidate on its first quarter total return of 12%, adding only 0.1% in total return in the second quarter of this year. So the first quarter also saw the current STI constituents recipient to $880 million in net institutional and net proprietary inflow. And then we saw outflow, net proprietary, net institutional combined outflows of 550 million in the second quarter of this year. So the relatively more cautious second quarter was also really seen across the region. The FTSE Asia Pacific Index, it generated a 4.5% total return in the first quarter of this year and less than a 3% total return in the second quarter. For the Orient, I guess for the second half ahead, the continued vaccine progress and curtailing these new cases is going to remain key drivers for particularly the service stocks that have been adversely impacted by the containment measures. At the same time, I think achieving herd immunities, vaccine equity, gradual recommencement of international travel and tourism is expected to increasingly rank high in the global policy agendas, which are becoming increasingly multilateral under the new Joe Biden administration. But from the current levels of around, with today's gains of 1.6% in the STI, which was easily the strongest market across APAC today. In fact, over the last 5 days, the STI has been the strongest benchmark across the world. It's been a recipient to institutions increasing their broad exposure to Singapore stocks on the last day of June as part of quarterly rebalancing. We've had robust economic data and, of course, further support measures announced yesterday. And for that reason, over the last 5 days, as I said, the STI has really led the world across the global benchmarks. But from these levels, let's say 3,200 now, I need to update this from this morning, the STI, it would have to rally another 3% to reach that pre-COVID-19 high back around 3280 on the 17th of January last year. To reach its May 2018 high of 3640, the STI would have to rally another 14%. And for the STI, if it was to return back to that 30 October low, it would have to decline by 25%. So at the moment, you can see there, I guess, some reference marks to where the STI has been in recent times. While the STI did gain 12% in the first half of this year, there was, importantly, a 60%, that's 60% differential in performance between the strongest STI stock and the least strongest of the 30 STI stocks during the 6 months. So resilient global trade and demand for container shipping saw Yangzijiang the strongest of the STI constituents with a 52% total return in the first half of this year, and also recipient to net institutional and net proprietary inflows in both quarters, with total inflows amounting to around 4% of the stock's market capitalization. And in that first half of 2021, the shipbuilder also secured new orders for 100 vessels worth $5.6 billion, which represented its largest order wins based on total contract value in the group's history. And at the same time, the STI's second strongest constituent last year, after Sembcorp Industries, the second best performer after Sembcorp Industries, which was Keppel DC REIT, was the STI's least strongest constituent in this past 6 months. Its combined net institutional net proprietary outflows amounted to 4% of its stock market cap. And the data center REIT, Keppel DC REIT, generated a negative return of 10% in the first half of this year, following on from its 38% total return last year, and of course the 66% total return back in 2019, which really helped propel that REIT into the STI. So while the digital economy continues to grow, progress towards this, I guess, social and economic normalization has put less demands on the cloud, digital services, and online services. The key driver really for the STI's performance, though, is a simple fact that banks made up the strongest sector across the globe in the first quarter of this year, and that very same sector makes up 40% of the STI through DBS, OCBC, and UOB. And bank stocks were amongst, as we said, not just the strongest industry in the first quarter, but amongst the strongest industries in the global stock market for the entire first half of 2021. That's really on globally resilient business investment. And of course, the 2 to 10 year US yield curve, it averaged 130 basis points in the first half of this year compared to 60 basis points in the preceding second half of 2020. And that really supported banks that, as we know, generally borrow short and lend long. Global monetary policy support also played a key role for the Fed Reserve balance sheets now grown to US $8 trillion. I think ECB balance sheet still stands near 7 trillion euros. And this policy stimulus has really supported businesses in all shapes and sizes, hence accounting for that resilient investment. Together, DBS, OCBC, and UOB, they were recipient to net net proprietary inflows of 1.4 billion in the first quarter, 468 billion in the second quarter. The trio also averaged a 19% total return, very much in line with the 20% total return for the 200 largest listed global banks by market value. And the average recovery in the price to book ratios for the Singapore banks has been almost identical to the price to book recovery for the top quartile of global banks by market value. But nevertheless, we have seen significant rotations. We did see that with the trio. They saw 145 million in net net proprietary outflow between the 3rd of June and the 18th of June, while the 2 to 10 US yield curve flattened by about 28 basis points. And that was all on hawkish Fed Reserve comments. And for the week through the 23rd of June, EPFR Global did see the largest outflow for financials since March 2020. And as we have these minutes, I believe what day's today? Tuesday. So it'll be, I think, tomorrow night, or it might be tonight, those minutes are released. And as we saw from the press conference, the Fed Reserve Chair did make a point of saying that there will be a lot of individual commentary from different governors, different members of the Fed Reserve, as they try to add more transparency to when they believe there will be tapering, but the individual comments don't all add up to a committee decision. Hence, markets will be watching that quite significantly. Following the first quarter FY21 earnings reports, the Bloomberg consensus 12-month target prices had increased between 4% and 7% for the 3 banks. And while the banks still average this 15% premium to book value, their price to book does remain on average well off the 40% premium observed back in April, May 2018. And for those PBs to be around that 1.4 level again, of course, you might, as you would recall, back in 2017, Singapore economy was amongst the strongest in the world. Singapore's stock market was amongst the strongest in the world. And that were the conditions for those PBs to be at that 1.4 level on average. I should keep moving quickly and into the manufacturing sector, because manufacturing has also been a resilient segment of the stock market, just as it has regionally in the different economies. Singapore's 20 most traded manufacturing stocks through the first 6 months of this year. They span these key 5 sectors: consumer non-cyclical, healthcare, industrials, materials and resources, and technology. Now, much like we saw in the STI, the 20 stocks averaged a 15% total return in the first half of the year, but like the broader market, very kind of flat, consolidated returns in the second quarter. For manufacturing stocks, these 20 stocks, they averaged a 14% gain, 15% gain in the first quarter of the year, and then the second quarter was just a 1% gain. We also saw Aztec Global list in March 2021, and of course Sri Trang Gloves Thailand listed in May 2021. Now, manufacturing stocks that were recipient, of these 20 most traded stocks that were listed for the period, that were recipient to net institutional and net proprietary inflows in both the first and second quarters. They included Yangzijiang, UMS, Franken Group, Golden Agri Resources, and Riverstone. I think importantly, in the UMS FY20 annual report, the chair noted that global chip demand for automotive electronics has been gaining momentum since the end of last year and will continue to serve as a key driver as demand exceeds supply. World semiconductor trade statistics also estimate semiconductor sales are expected to accelerate this year, growing to 8.8%, with of course, pandemic-fueled demand there as well. So far this year, the Philadelphia SOX index is up 22%. I guess, hang on just a second. More recently, technology was the strongest segment in the global stock market, particularly in the last, I guess, coming into the beginning of July, and that's really been led more by the advanced manufacturing and semiconductor stocks than the downstream digital economy plays. The world's largest global internet stocks, they trade at pretty high PE ratios, around 65 times, more than double the 30 times PE ratios for the world's biggest semiconductor stocks. But Singapore's PMI, it has shown that sentiment in the broader manufacturing sectors has been inching higher than the previously strong electronics PMI. For instance, the broad June PMI came in slightly above expectations at 50.8, up 1.1 from 50.7 in May, and representing now 12 months of expansion. The sub PMI indices of new orders, new exports, and output, they all gained, with the new orders and the new export sub indices also up now from the end of 2020. The electronics sector, it did post in June an 11th month of expansion, returning to 50.6 after being down at 50.4 in May. But note the electronics PMI, it finished 2020 at 51.2, so it's below its end of 2020 level, unlike the aforementioned broader PMI, which is above its end of 2020 level. So similarly in 2020, Singapore's first quarter manufacturing growth, it was supported by output expansions in electronics, precision engineering, chemicals, and biomedical manufacturing clusters. But that really outweighed these output declines in transport engineering and general manufacturing. And for the next upcoming quarterly manufacturing report for the second quarter, the industry will be looking for further signs of broader growth beyond just the technology segments. But across Southeast Asia too, the broader manufacturing recovery, it has been impacted by a resurgence in COVID-19 infections. I think it was last week on the 30th of June, the MAS managing director, he did note that in Southeast Asia, the recovery has been impacted by varying intensities, and the weighted average of Indonesia, Malaysia, Thailand, Philippines, and Vietnam manufacturing PMIs that are weighted by their shares in Singapore's NODX, non-oil domestic exports, they fell from 53.1 in April to 51.7 in May, even as the global index strengthened. So the focus on the impact of the regional manufacturing is important. Venture Corporation, it did provide a general corporate update on the 23rd of June. It highlighted, despite the recent challenges of the endemic, its entities in Malaysia have been able to continue operations as an essential economic sector, and that's enabled Venture to deliver on its customer and partners' commitment. For these stocks here, ISDN was the strongest of the 20 most traded manufacturing stocks, and on the 18th of June, ISDN did announce a global strategic partnership with communications solution provider WizSpace to deliver wide area Industry 4 and Internet of Things solutions globally. What it also has noted is given quite a bit of detail on the outlook for regional supplier and value chains, and it did note in its AGM Q&A back on the 30th of April, it had been seeing the benefit of China's broad ramp in semiconductor capex in its business, and that was firstly through the geopolitical industry competition and the global trade tensions having this impact of diverting trade and supply chains and capital to Southeast Asia. Secondly, ISDN noted the trade tensions have accelerated China's industrial push towards Industry 4 automation as it seeks to avoid competing with Southeast Asia on cost and seeking instead to push up the value chain into advanced industries. Moving up the value chain, or to push up the value chain, so to speak, it basically involves developing new products and services and creating new value propositions that impact the entire broader chain. And that thirdly, the ISDN believe China's technology ecosystem is looking to reduce its reliance on the US and European technology in favor of Asia-centric suppliers. So as highlighted even by the EDB, Singapore really has embraced Industry 4. It is moving up the industrial base, I guess, our industrial base up the value chain to strengthen the position for us as well as a leading industrial hub for companies worldwide. But really, when you look at the parallels of this, the economic role of manufacturing in Singapore economies, we know we have this 20% impact on our GDP, and similarly, these 20 most traded stocks with manufacturing related activities have also contributed around 20% of the combined average daily turnover of 1.4 billion of daily turnover for the entire market for the first 6 months of this year. Now, one more quick final point is that We are seeing significant sector and industry rotations over the past 18 months. Both macro and micro developments are seeing more frequent rotations, both across the various stock market sectors and also among the very different industries within the different sectors. As we saw in recent months, recent recoveries in global demand has seen the energy sector outpace this energy sector, which I can think I'm identifying in the arrow, really outpace many of the other sectors on a market cap weighted basis. And the dispersion in sectorial performances amid the challenges, I guess, of the past 2 years really have seen an average monthly 15% differential, with the median gain of the top performing sector since July 2019, adding all these, looking at all these gains and comparing them, 11% gain, a median of 11% gains every month for the past 2 years, compared to a median 4% decline for the least performing sector over the last 2 years. So rotations that they've seen the healthcare sector, one of the least performers in this first half of 2021, after healthcare led the sectors with materials in 2020. And for some more specific examples on those, as we said, we saw those banks with the flattening of the yield curve, some rotation out of there. In the month of February, we saw Singapore Airlines and SATS. They were recipient to around $250 million of combined net net proprietary inflow, while the majority of the US, China, Japan, UK were seen to overcome their COVID-19 resurgences in January. At the time, it really boded well for the resumption of international travel, and that month, Singapore Airlines share price gained 21%, in line with the 20% gain for the world's biggest airlines, while SATS gained 14%. And I guess more on a strategic structural front, CapitaLand, it was recipient to 23 million in combined net net proprietary inflows, with a 15% price gain in the 3 sessions that followed its 22nd of March corporate restructure proposal. And remember, CapitaLand is looking to restructure its group business to consolidate the investment management platforms, as well as lodging businesses. It's lodging business into the CapitaLand Investment Management, looking to attempt to create Asia's largest and the globe's 3rd biggest real estate investment management. So just on a quick end note, that we have the Telegram channel, which I think has more than 20,000 subscribers now, that we colloquially call SGX Invest, and we encourage you to find us on Telegram, where we can find a way to keep you updated on market events, relevant insights, and so forth. And of course, we are still sending out the weekly SGX My Gateway report. So I'll quickly finish off here and stop sharing the slides. Make sure I do it right. And hand over the presentation to Sri Trang Gloves Thailand, which we're looking forward to hearing more from. Thank you.
Thank you, Geoff. Next, we are pleased to have the representative of Sri Trang Gloves with us tonight. He'll be sharing with us more about the organization. Let us welcome Ms. Tipwadi, the Head of Investor Relations, and Ms. Vanessa from Investor Relations. Over to you, Vanessa.
Okay, so to start with the presentation of Sri Trang Gloves Thailand, let's start with a brief introduction of the company. Sri Trang Gloves Thailand, or STGT, is Thailand's largest and the world's 3rd largest glove producer, with total installed production capacity of around 33 billion pieces. STGT is a subsidiary of STA, or Sri Trang Agro Industry, which is the world's leading natural rubber company, with around 56% of the shares of STGT held by STA. And STGT itself has 4 subsidiaries. The first 2, SDME and STU, are responsible for the marketing and distribution of our products. In the case of SDME in the Chinese market, and in the case of STU in the United States. And PSE provides engineering services to STA and STGT. So for the capacity expansion projects of STGT, it is PSE that is responsible for the construction of production facilities and the installation of production lines. And lastly, PS was formerly a subsidiary of STA. And PS happened to own the land in Songkhla that STGT wanted to use in the capacity expansion because the land would entitle STGT to a corporate tax exemption of 8 years. And so STGT decided to acquire the land by way of share purchase because it was more financially attractive. Next, let's look at the products that STGT produces. The gloves that STGT produces can be broadly categorized into latex powder gloves, which are the most affordable and are widely used in the emerging countries, like in China, in Asian countries, in Africa, Latin America, the Middle East. The second one would be latex powder-free gloves, whose selling prices fall somewhere between latex powder gloves and NBR gloves. And lastly, nitrile gloves or NBR gloves command the highest selling prices and are the preferred gloves of the developed markets like the US, European countries, and Japan. If you look at the revenue contribution, because of the higher selling prices, NBR gloves contributed the largest proportion of our sales revenue in the first quarter of this year at 46%, followed by NR powder gloves at 31%, and NR powder-free gloves contributed 23% of our sales revenue for the first 3 months of this year. Our business model, we are still mainly the majority of products that we produce are still OEM products at 71%. But the outbreak of COVID-19 since last year has provided an opportunity for us to grow the market share for our OEM products, which now account for 29% of our sales volume in the first 3 months of this year, which has grown quite significantly from pre-COVID. Our share of OEM products used to account for only around 20% last year and lower at around 16% in 2019. On the chart, you can see these are our OEM brands, and these are mainly marketed in Thailand, where our brands have become household names in CLMV countries where they are very, very popular, and also another country where our brands make up a sizable chunk of sales volume would be in China. And we also market our brands as well in the US. Ever since the second quarter of last year through to the first quarter of this year, our production facilities have been running at full capacity with the utilization rate of around 95%. Now, let's look at some of the factors that differentiate us from our competitors. The first one is that unlike most of our peers who focus on NBR gloves, we are producing both natural rubber and NBR gloves, and this means that we have market share in both the developed markets and the emerging markets. And for the production of NR gloves, natural rubber gloves, We source the latex that is used in the production of our gloves from our own parent company, STA, and this guarantees that we have access to a steady supply, and so we don't have to stock up on concentrated latex. And because our production facilities are located in the same vicinity as the latex processing plants of STA, we can also save on transportation costs. And because we are sourcing the latex domestically, we are not subject to the so-called SIAS tax, which the Thai government imposes all exports of latex at the rate of 1.2 baht per kilogram. So taken together, the savings on the SIAS tax and the transportation give us around, means that our production costs for latex gloves are around 6 to 8% lower compared with our peers who all have to import the concentrated latex from Thailand. And another factor that differentiates us is that unlike our peers who use natural gas as fuel, our production facilities are run by wood chips, which are considered biomass. And this means that our energy costs are around 10 to 15% lower than our peers. And for our capacity expansion projects, we also benefit from the interest rate subsidy scheme of the Rubber Authority of Thailand, which provides a subsidy of up to 3% of interest rate. And because our effective tax rate is only around 2%, this means that all of our interest expenses are fully reimbursed by the Rubber Authority of Thailand. And this program will continue until the year 2026. And aside from, the last one, we also benefit from the Thailand Board of Investment, the tax exemption of between 5 to 8 years. So this is the reason that we have been able to keep our effective tax rate in the single digit. So ever since the emergence of the outbreak of COVID-19, there has been a lot of new players who have expressed interest in joining the glove industry. But actually, the industry has a quite high barrier to entry. First of all, glove production is it's an undertaking that requires significant investment and sophisticated technology. The construction of the production facilities itself takes at least around 18 to 24 months. And aside from the construction, medical gloves are required to have certificates from the relevant regulatory bodies in each of the countries in which they are to be marketed. And the approval process, which varies by country, usually takes at least around 6 months, but in most cases, it would take longer than that. And because with our over 3 decades of experience, of industry experience and our expertise, we are confident that we will be able to continue to be in this leading position in the glove industry, in the global glove industry. So for the next part of the presentation, I will hand over to Ms. Tiwati.
Thank you, Vanessa. But this part is about the financial performance. I would like to say that for the glove consumption, the demand is very strong and robust. All of you know that. It's driven by the demand from medical and non-medical sectors. So our performance in 2020 was remarkable, and we can continue this momentum to 2021 as well. You can see that in the first quarter this year, we achieved the all-time high revenue at 15.4 billion baht with 30% growth quarter-on-quarter and 310% growth year-on-year. This was mainly due to a strong increase in average selling price or ASP. It increased 21% quarter-on-quarter and 284% year-on-year. And you can see that on the sale volume, in the first quarter this year, we achieved the sale volume at 6.7 billion pieces, which is dropped by 6% quarter-on-quarter. This was mainly due to the problem of container and ocean vessel space shortage, which is a logistic problem. While our utilization rate, we run at 95%. And for our products, as Vanessa mentioned in the first part, we have three kinds of products. So for NBR is nitrile glove. It contributes the highest portion at 46% of the total revenue, followed by latex powder glove with 31%, and latex powder-free glove with 23%. And on the right-hand side, you can see that our market is so diversified. It's different from our peers in Malaysia. If you gather the market between developed market, we have around 50%, and developing market or emerging market, we have around 50% as well. While comparing to other peers in Malaysia, they focus on developed market more than 60%. So this is our difference, and we can call it our unique as well. And for the gross profit margin, as I mentioned earlier, that our average selling price or ASP is increased 21% quarter-on-quarter, while the raw material cost increased lower than that. So you can see that our gross profit margin in the first quarter this year, we achieved at 74%. This is very high comparing to other peers in industry as well. And for selling and admin expense, due to the robust glove demand and the strong increase in revenue, we can utilize and benefit from the economy of scale. You can see that our SG&A to sale was at 2.9% in the first quarter. And for this chart, you can see that we have a slightly bigger portion of selling expense in the first quarter this year. This was due to an increase in logistic costs. As I mentioned earlier, that we have some problem about container shortage, which is a global issue. And for another item is the admin expense. We also have one-time expense related to the fire accident in Surat Thani Plant 2, which is amounted to 49 million baht. This 49 million will be fully fully covered by insurance claim, and this insurance claim will be booked in the second quarter this year also. Another part is the Ebitda. Our Ebitda margin in the first quarter this year, it was at 72%, which is equal to the fourth quarter last year. This was mainly due to a loss on foreign exchange hedging transaction due to the stronger of Thai baht due to the weakening of Thai baht comparing to US dollar in March. And due to another part is the interest expense. You can see that at the end of March, we have loans amounted around 6.4 billion baht. Almost 100% of that are the loan under the subsidy scheme of the Rubber Authority of Thailand, or RAOT. If you were the glove maker or condom maker or tire maker, if you want to expand your capacity, you can prove to Thai government that when you expand your capacity, you can consume more natural rubber in Thailand. The government will give you 3% interest rate subsidy till 2026. And we apply for this subsidy scheme. So you see on the right-hand side that our interest expense in the first quarter was as
Wadi, sorry to interrupt. I think you are muted. Can you try to unmute your mic?
I used the microphone of Vanessa, sorry.
Okay.
Okay, we view together. So in the right-hand side, the interest expense was at 2% and the government subsidy 3%. So it means that we can have interest-free loan, and this is our benefit. And apart from interest expense that we can save, tax expense as well, we apply for the tax haven scheme from the Board of Investment of Thailand. In every plan that we expand our capacity, we can have 5 to 8 years tax-free for that. So in the first quarter, you can see that the effective tax rate was at 6.8% for us, STGT. And for the next 7 years to 2028, our effective tax rate will not be over than 7%. This is our forecast. So in sum, the strong increase in revenue and the well-manageable cost, we could generate a strong net profit at 10.1 billion baht in the first 3 months this year, together with the highest net profit margin in the industry at 65%. So this is very our performance. This is our performance, and we can deliver a strong performance and strong financial status. So we can pay dividend to shareholder in every quarter. And our dividend policy is that we will pay not less than 50% of our net profit. So this is all about the financial performance that I would like to share to you. I would like to hand over to Vanessa again for the next part.
So for the next part, let's look at the overview of the global glove industry. So despite the ongoing and successful vaccine rollout globally, global demand for gloves continues to be strong, with a shortage expected to persist well into 2023. And the outbreak of COVID-19 not only led to an explosive growth in demand from the medical sector last year, it has also expanded the user base of gloves to include new sectors that had never before used gloves. Sectors like retail, logistics, restaurants, hospitality, or even aviation. And going forward in the post-COVID world, we expect that the demand from these new sectors will continue to sustain the overall glove demand globally. And because of the increasing awareness of health and hygiene that has resulted since last year, especially in the emerging markets where currently the per capita consumption of gloves are still in the low single digit, as you can see in the charts. And because of the variety of our products, we have market share, we have customers in every continent, in every continent of the world, in both the developed markets and in the emerging markets as well. So for us, we do expect to see high growth in the emerging markets. So for our capacity expansion plan, currently we have around 33 billion pieces in installed production capacity. And this year we're adding an additional around 3.2 billion pieces. But a bigger chunk of additional capacity will come next year We're adding next year around 14.5 billion pieces, which would take us to around 50 billion pieces by the end of 2022. And in the longer run, by the year 2024, we expect to reach around 80 billion in installed production capacity. And for our expansion up to this 80 billion pieces, we have already identified the locations that will be used in our expansion projects. And the first production facility of this overall expansion project, SR2, has already been up and running since earlier this year. And by the end of this month, we expect that SR3 plant will start operating. And all of the locations that you can see on the slide will entitle us to a corporate tax exemption of between 5 to 8 years. And all of the production lines that we will install at all these locations will be of the switchable type, which means that they can switch between producing NBR gloves and latex powder-free gloves. So this gives us the flexibility to adjust the proportion of our product mix to suit the market demand and as well as the raw material situation in any given moment. So as Tiwari mentioned earlier this year, there was a fire incident at our Surat Thani plant 2, but everything has been resolved, and the plant has resumed operation since late April. And also earlier there was a COVID outbreak at our Surat Thani location and our Trang location as well, but all of the issues have been resolved, and currently we are in the process of vaccinating all of our factory workers with Sinopharm vaccine. So this year, SR2 plant has been up and running. Later this month, SR3 is expected to be operational, and down the pipeline later this year as well, we expect that these two plants, PS plant in Songkhla and TG3 plant in Trang, will start operating. And aside from new production facilities, this year we are launching also new products. The first product that we will launch is we call it latex powder-free gloves with no detectable protein allergen. And this product is a result of the collaboration between STGT and our parent company, STA. And what we have done is that our R&D team has come up with a way to lower the protein content in the concentrated latex to the extent that it would not cause allergic reaction in users. And so our hope is that we will use this product to grow our market share for NR gloves, especially in the developed countries where currently there is still a strong resistance to NR gloves because of concerns on allergy. And eventually we expect to be able to market this product in the US, but we will start first with Europe and in Japan, where the approval process takes less time. And another product that we are launching in the second half of this year is latex powder gloves, to which colors have been added to make them resemble nitrile gloves. And we think that this product will appeal to customers who like the looks the color of NBR gloves, but do not necessarily require the special properties of NBR gloves. And because this product is made from natural rubber, they are biodegradable and therefore it's an environmentally friendly alternative to NBR gloves. And earlier in May of this year, we also reached another milestone. We became listed on the SGX. This is our secondary listing via share transfer. And lastly, on an issue that is gaining increasing importance, we want to reassure everyone that we have always been in full compliance with all labor laws and regulations. We have never had any issues with any labor regulators in any of the countries that we operate. And we have received the highest A rating in the BSCI and social audit by Amfori, which is an internationally recognized labor organization. So on this issue, we would like to assure everyone, our investors. So that is a wrap for our presentation. I will hand over the next part to our CFO, Ms. Thanawan.
Thank you, Ms. Tipwadi and Ms. Vanessa. We'll now proceed to the Q&A session. You may post your question in the comment section below and we'll endeavor to answer them. Due to time constraint, we would like to seek your understanding that not all questions will be addressed. Without further ado, we would like to invite our moderator, Mr. Richard Dyson, the General Manager for Planning, Education and Research at SIAS, and our panelists, Ms. Thanawan, the Executive Director and CFO, together with her colleagues, Ms. Tipwadi and Ms. Vanessa, to start the Q&A session. Over to you, Richard.
Good evening, Kun Thanawan. How are you?
Hi, good evening, Richard.
From Singapore to Bangkok, I know we are waiting to travel. We're waiting for, I think there is this corridor in Phuket that's open, but unfortunately we have this stay home notice every time. We can't afford to spend 2 weeks of leave sitting in the hotel yet. But hopefully this whole situation will be able to visit and pay you a visit in Bangkok soon.
Yeah, definitely. You can come to Phuket first for the Phuket sandbox for 2 weeks.
Yes, it's interesting. It's a sandbox. Definitely, I love Phuket. So it's been, and congratulations first and foremost on the well-received listing on SET last year, as well as a very successful listing on SGX in May. Very, very brave to do all this during a pandemic, but perhaps it's also an opportune time for Sri Trang Gloves to capitalize on this heightened demand for gloves during this pandemic. At the same time, we're also seeing that it's also a very competitive market space that you are in. Plenty of players offering, these products at very low margins. Then maybe to some of our listeners, how do you then differentiate your products? As the third largest maker of gloves globally, how does Sri Trang Gloves look to compete with your peers in this crowded marketplace? Other than just cost, what does Sri Trang Gloves and its offerings really stand apart from its peers? Perhaps you could just share a little bit of this, this aspect of a very competitive market space.
Sure, we should. This is a very good question because look at a glance, we may be indifferent from the others in terms of we are producing the examination glove for medical purposes. But in fact, if we look into details, we are quite different from our competitors. We say that our colleagues from other countries like Malaysia or even China. If you look into the product mix itself, most of, let's say, I would say that 100% of our Chinese players are producing non-natural rubber gloves. It could be either a synthetic rubber or plastic-based rubber, which is PVC and NBR. So they produce only two types of glove for the competitors in China. For our Malaysian, they gear toward NBR more and more. The expansion of their capacity, look at back for the past 10 years, they have shifted from the NR glove. When I say NR is natural rubber, to the NBR. And the expansion plan of our Malaysian competitors in the future, they will focus on the NBR glove. Whereas compared to us, we have the product mix around, let's say, in terms of the capacity-wise, we have our NBR capacity right now is around 35%. And in the next couple of years, it could be increased to somewhere around 45 to 50%. But we still have the good balance of another 50, or it could be up to 65% of the NR glove. And this NR glove, we have used our competitive edge in terms of the proximity to the source of the raw materials, as my colleague has already explained. Because Thailand is the world's largest natural rubber producer, our parent company is the world leader in terms of producing the NR products to the customer worldwide. And in addition of the cost saving in terms of the transportation, export tax, import tax, it allows us to develop the product, not just only the conventional NR product, but my colleague has explained that we are doing R&D to innovate different kind of new NR product to serve the market worldwide. And the NR product itself is really suitable for the high growth countries, which is, I would say, the emerging markets, whereby those countries cannot afford the expensive glove. They want to lift it up the standard of the healthcare at the affordable price of the PPE. And you can see that the price of the NBR or even the NR powder free is more than 50% expensive than the NR powder. So those countries, obviously, they could not afford to use that kind of glove. So the powder glove, it is the answer for them that is affordable in terms of the price, in terms of the properties, is on par and even indifferent from the other products. So it could be the hand protection for medical purposes. So we could see that for the past, let's say 5 years, 7 years, the growth rate of our sales to those emerging markets, for example, like Africa, Latin America, or even Middle East, we have contributed CAGR growth on those markets at least 60 to 70% year on year. So this is a high potential market for our product. So this is what we are different from the others.
Using a portfolio approach to actually look at it and then different product mix for different geographical regions, and therefore be able to optimize the profit margin accordingly, right?
Exactly, Richard. And in addition of that, our government is really supportive and promote the industrial in the country, and also to promote our competitive edge of the world leader of natural rubber. So you can see that of course we have a certain leverage to use the debt to finance our expansion and growth strategy, and all of the loan that we borrow from the bank, it's interest free. So we got fully subsidy from the government. And in addition of that, we are paying the corporate tax rate, not 20%, not even 25%. We're paying like 5 to 6% effective tax rate, which is extremely low. So that could enhance the return to the shareholders by ways of, net profit, etc. Yeah.
Can you borrow money for me? We've got a question from one of the listeners, one of the viewers today. And I think you mentioned about this in the slide. It's 102 billion pieces by 2026. How does this compare in comparison with Malaysia? I mean, globally, what sort of percentage are we looking at this? So if we look at in 2026, where are you looking to be? Roughly, I don't think we have the right answers, but how does this compare with, say, Malaysia? And I think these are some, because a lot of times they're looking at Malaysia as an example of a local competitor.
Right, yeah. So you can see that from the profit that all of us has made, and particularly from Sri Trang Gloves, we are proud to say that I think for the 2 or 3 consecutive quarters, we have delivered perhaps the highest profitability among the others in this industry. Our Ebitda for last quarter was around 72-75%. Net profit was around 65%. So this kind of margin, I have to say that it's really attractive to draw the attention from not just only existing players but the newcomers, to grab this kind of opportunity as well. So going forward, you will not be surprised that a lot of new capacity will be added up to this industry because of the attractive profit that we have made due to the high demand during this kind of pandemic. So you can expect that the not just only us, the others competitors, they will also expand their capacity as well. But one thing that we have to to highlight is that, as I said earlier, that the Malaysian players and also the Chinese player, they will expand only 2 products, which is the NBR, and Chinese player, they may expand the PVC. Which is previously pre-COVID, PVC was the cheapest glove among the other type of the glove. And the only one that could expand 2 types of glove at the same time, I mean NR and also NBR, is probably only Sri Trang Gloves. So and our machine that going to be newly invested, it can be switchable. So it could produce both NBR and also it could produce NR, so powder-free base for both types. Depends on the raw material availability, depends on the margin, depends on a lot of factors, even the price of the glove itself. So we could be flexible to produce any type of the glove that could serve the demand appropriately to enhance our profit in the future. So it is rather difficult to say whether in 2026, with the capacity of over 100 billion, what our positioning will be, because we have to look into the others' expansion plan as well. But we still believe that we still maintain our ranking as one of the top leaders, maybe top 3 or top 5 or whatsoever. But more important than whatever the number of the ranking we are in the industry, we have to focus on our competitiveness in long term. We have to focus on how we can maintain the profit in long term, even the post pandemic situation. That's going to be the key. Yeah.
You shared a lot about some of the opportunities and some of and you're basically the high growth areas, especially that you've had, and with very good performance. But perhaps you could share a little bit more about some of the risks that Sri Trang faces, especially in the major segments that you operate. I think investors would like to understand how you're managing these risks as well.
Right. First of all, if we look into the situation right now, whereby new supply has been adding up into industry because of everyone keep expanding. Yeah. So the decrease in the ASP, the selling price of the glove, is one of, I would say that most of the concern when I talk with any investor, they're concerned that what our expectation on the ASP in the next 6 months, in the next couple of years or whatsoever. That's that's going to be the factor that is, I would say that it's unavoidable in a way, because we expected that the SP has to come down. Glove is not meant to be expensive PPE at all. I have to say that pre-COVID, you can see that one piece of glove doesn't cost, not so many cents, but the pandemic drive it to be, the maximum could be like $2 or $3 a piece. So that's too expensive. And when I say that glove is not meant to be expensive, because if it is too expensive, if it's not affordable by the user, particularly for let's say for the whole population, not just only the rich country, it will destroy the whole industry. Meaning that you will see the improper glove coming to industry. For example, like the second-hand glove, which is not hygienic, is not illegal, all that thing. So we have seen a lot of this kind of thing when the price was spiked. So glove has to be, I wouldn't want to say that cheap. Glove have to be affordable. So the price has to come to the level that it can keep the user to remain using this product as a single-use product, not a recycle or reusable product. So it got to be an optimum price. So and the price adjustment is one factor that it had to be in the reflection of the new supply. So this is let's say the price raise is one thing that we have to bear in mind in the situation of the capacity, the new capacity has been adding up. And for us as an exporter, or even for us itself, COVID is our our risk as well, because you can see that because producing the glove, even though we try to gear towards automation, Internet of Things, AI, whatsoever, but we have to say that we still rely on certain, number of workers, human, in our factories, and COVID could be one of the concern if it's the number of cases has been increased or affect our production. And you can see that Malaysia and Thailand, now we have the cases increasing. So that could be the risk. And that may affect the kind of the capacity utilization in the future. But we hope that because we have lifted our, safeguard, we try to put higher standard to protect our factory from the COVID as much as we can. Last month, we have to close down one of our factory for about two weeks because of the COVID. So we hope that should be the last case, and we hope that we can continue operating our production without COVID affected. So I think for the timing, two key risks that I like to highlight. Yeah, I think the others, for example, like the FX risk, I think it's quite normal in this industry.
I think, yes, we just hope that everybody will be vaccinated safely, and then we just have to take safety measures at a slight importance at this stage.
Yeah,
I just want to finally, I think we're closely running out of time, so I just want to end off with this point about ESG, because these days we can't, everyone is now looking at the environment. Social and governance factors is top of mind in all major investors. So perhaps can you briefly explain how does Sri Trang look at incorporating ESG considerations into its operations? How does management see the opportunities and the challenges in doing so?
All right. Thank you very much. Yes, you are right that this ESG has become prominent and very important, not just only for the investor communities when we talk with the institutional investor, particularly from the Western side or Japanese side, but also for our stakeholder as a supplier and also customers as well.
Yes.
And we are so proud that we think we are second to none for the ESG in terms of the put this thing in our heart and doing ESG with the high consideration. Firstly, as I say that this industry still rely on a lot of workers. For us, we have around close to 9 billion, is around 8.8 billion headcounts working in our 3 location based in Thailand. And we are so proud that we are rated by the a Scandinavian organization, we call it Amphori BSCI, which is really reputable organization doing a rating in terms of the treatment of the workforce. And we are proud to say that 2 of 3 of a factory has been graded as an A, which is the highest rating that BSCI could give. And our A is A in all criteria, in 13 criteria that they are rating. So, and another factory, we got the B grade. Just only one that is missing because we miscalculate the daily wages of our security guard for few cents dollar. And so our grade has been deducted from A to B. So you can see how strict they are in terms of the giving the rating. So we are so proud that we treat our staff very well. We give the fair treatment to our staff. And even for COVID situation, we have just successfully for our almost 9,000, not 9,000, not 9 billion, sorry, 9,000 head count that we have in our factory. All of them had got the vaccination, the first jab. It was done a couple of days ago. So we have invested not just only to protect our white collar, but we also concern the blue collar, regardless of the nationality they are. So Myanmar, Thai, Laos, Cambodia, we give vaccination to them, all of them fairly. And in terms of the environment, yes, we are different from the others. In terms of producing the glove, we use the waste rather than the fuel-based energy. So we use wood chip, which is the wood that the farmer chop from the palm oil, from the rubber plantation, and then we chop it in the small pieces and burn it and use as a source of energy. So we generate the waste, the energy from the waste, which is unlike the others. In terms of the electricity, the steam, and the water, we have set criteria every year to reduce the usage of those resources and to enhance the productivity and do the cost saving. And in terms of the governance, we have given a lot of awards from the Stock Exchange of Thailand, the Prime Minister Award, a lot of organization. I don't need to go through all of them, but so please put we trusted that ESG is the consideration that we put as our heart of running of the business. Yes, Richard.
Thanks, Khun Thanawan. I think we're running out of time this evening. It was a very, very interesting presentation. Very interesting, very enlightening. So thank you to you and your team for spending time with us tonight. And we really, really look forward to seeing you in person very soon.
Thank you very much. Thank you, everyone.
Thank you.
Thank you.
Thanks,
Bye-bye.
Richard. Thanks, Ms. Thanawan, for your
Back to you,
input.
Michelle.
Thank you, Richard. Thank Ms.
Thank you,
Thanawan, for the
Michelle.
input.
Bye-bye.
Thank you. Bye-bye. We have come to the end of today's webinar. It has been a pleasure to have you with us this evening. In case you missed any part of today's session, you can rewatch the webinar on SIAS Facebook. The next Corporate Connect webinar is on the 27th of July, 7 p.m. Please continue to like our page and visit our website to get updates on our upcoming investor education programs and initiatives. Thank you and have a good evening.